Good morning, everyone. This is the sixth day of our just 20 minutes lectures. So we'll be completing, as you know, we'll be completing in 15 days the entire subject of direct taxes using 30 pages only. Okay. So in the fifth day, we did income from other sources and dividend income. We'll also be doing further of income from other sources, section 56 to 10. Okay. Those of you who have already bought the memory book, you please write 5 points here. These are the checkpoints. If these checkpoints are satisfied, then only 56 to 10 is applicable. Okay. The first checkpoint is check the receiver. Right? Check the receiver. So if you have written check the receiver, now if the receiver is any person, then 56 to 10 will be applicable, except when a receiver is receiving by a trust, 1023C trust, or by on the occasion of marriage of individual. Is marriage anniversary written here? No. Is birthday written here? No. So if a receiver receives on occasion of birthday, 56 to 10 is applicable. If the receiver receives on occasion of marriage anniversary, then 56 to 10 is marriage, 56 to 10 is not applicable. If the receiver receives under a will or by way of inheritance, it is not applicable. Similarly, if the here we talked about receiving from a trust, 1023C trust. If received by 12A 12AA trust, then also taxable, 56 to 10 will not be applicable. So first point is, speak with me, check the receiver. First point is check the receiver. Now check the giver. Giver, the main element in giver is relative, the definition of relative. So if the giver is a relative, then 56 to 10 is not applicable. Okay. Also, for the receiver, if the receiver receives by way of transaction not regarded as transfer under section 47, if you remember, 4, 5, these two are amendments, holding to subsidiary and subsidiary to holding. If given and the asset received is below market value, the consideration is less than market value, then 56 to 10 would have been applicable, but because of this exception it will not be applicable. Okay. Second point, right here, check the giver. First point is check the receiver. Second point, right, check the giver. Okay. If giver is a relative definition of relative is, look carefully. Okay. There's some high level concept here. The the definition of relative is, for example, Mr. A is me. For me, my spouse is a relative. Okay. Then there's a box. Please note that there's this box. Okay. After this box, both both mine and my spouse's brother and sister are my relatives. Okay. Both my and my spouse's mom and dad are my relative. Both mine and my spouse's lineal ascendant and lineal descendant are my relative. But mom, mom's brother sister, dad's brother sister of only Mr. A is Mr. A's relative. Okay, so if you remember this chart, the first is the primary thing is Mr. A, Mrs. A, a box, then brother sister, then mom, dad, lineal ascendant and descendant. But only Mr. A's mom's brother sister, Mr. A's dad's brother sister are their relatives. Okay, and of course spouse of any person mentioned above. If the receiver, if the giver is 12A double A institution, 1023C institution like we mentioned here and here, it will be exempt. So the basic 2 points are check the receiver, check the giver. Okay, now the third point. Now 56 to 10 provides that if you receive an asset or cash below FMV, for cash FMV is the amount. So if you receive cash free of cost, and it exceeds 50,000. So if a cash received is 51,000 on occasion of birthday, is it taxable? Yes. Birthday is not covered here. Okay. So if 51,000 is received by way of gift, is it taxable? Yes, it is taxable. How much? 1,000 or 51,000? Entire 51,000. So the third point is, if the difference exceeds 50,000, entire difference is taxable. Repeat with me. If the difference exceeds 50,000, entire difference is taxable. You getting? Yeah. Write down the third point. If the difference exceeds 50,000, entire difference is taxable. Okay. Now this is the second. The first limb is for cash. The second limb is for, it's for property, and that too movable property. Immovable property is land, building, or both. And like we mentioned in 50C and 43CA, 5% basic benefit to the assessee, that is also made available under section 56 to 10. Okay. If stamp duty value exceeds 105% of sales consideration and it exceeds 50,000, entire difference is taxable. Again, entire difference is taxable. For movable property, the fourth checkpoint is write down asset should be a property. Definition of property. Write down definition of property. Why I'm telling you this is because the definition of property under 56 to 10 is not inclusive. It's exhaustive. It provides that sad EPJ, like we had a discussion for Caplins, sculptures, archaeological collections, drawings, any work of art, paintings, and jewelries. These are, of course, property as per 56 to 10. In addition to that, shares, bullion, shares and securities and bullion are movable property for 56 to 10. Okay, so 56 to 10, the definition of property is very important, because if in the question it provides that Mr. A provided free of cost to Mr. B a watch, is it taxable to Mr. B? Has Is watch covered under the definition of property? No, not taxable. Clear? Yeah. And the fifth checkpoint is per clause all person. Per clause all person. You can have a look at my main book, in that I have mentioned example for per clause all person. For example, I received 50,000 of movable property free of cost. For example, 50,000 1 rupee of movable property, rather 50,000 of movable property and 50,000 free of free I received cash. 50,000 and 50,000, it comes to 1 lakh. Is it taxable? No. Per clause all person means, for this clause I will see from all the person I have received. For this clause I will see from all the person I have received. Then I'll check whether it is exceeding 50,000. Not that I'll combine both these clauses. So fifth checkpoint is, write down fifth checkpoint is per clause all person. If you want to have a look at my main book, last example is specifically covered for per clause all person. Okay. Now we see we come to clubbing of income. Clubbing of income background is Mr. A transfers to Mrs. A, saying that she is my relative. I'll transfer all my income generating asset to Mrs. A because she has lower income, hence will claim benefit of exemption, basic exemption. Income Tax Act says wait, it's not so easy. You come under clubbing. Clubbing is, of course, to prevent evasion of taxes. So transfer of income without transfer of asset, it is to be clubbed. Write it right here, club. Transfer of income, how is it possible? So for example, I am owning debentures. While mentioning in the policy documents, I mentioned that the interest is to be credited in my wife's account. So if that's the case, it is, am I transferring the debentures? No, debentures are held in my own name. PAN is mine, but the income is transferred in the hands of my spouse. That will be income, transfer of income without transfer of asset. It will be clubbed. Okay. If asset is transferred and it is a revocable transfer, it has to be club. If at it, you have it, write it here, club. If asset is a, if there's a transfer of asset and asset and transfer is a irrevocable transfer. Mind it, irrevocable transfer is that I cannot revoke during my lifetime. Okay, so what I'll say, what the income tax says, that it will not be clubbed normally, but some relationships. So other cases, write it here, don't club. But some of the cases, the income tax act says that you may not be transferring it for, you may be transferring it irrevocably, but there's a element of tax evasion, so we'll be taxing that in your hands, in the hands of transferor. For example, right, this is transferring directly or indirectly to spouse or daughter-in-law. Transfer to spouse and daughter-in-law. Okay, so the main section is 64. For this it is 1 4. Write it here. For this it is 1 6. For this it is 64 2 for HUF. This is for HUF. Okay. Transfer to spouse. Now you'll remember this with the help of images. Transfer to a spouse for inadequate consideration. If this would have been this amount, it would have been adequate. Since only half amount is received, for inadequate consideration and not in connection with agreement to live apart, then it will be clubbed in the hands of transferor. Other cases club. In case of house property, section 27 comes into play. Section 27 provides that if a person transfers to a spouse for inadequate consideration or in connection with, or not in connection with agreement to live apart, the transferor will be deemed to be the owner of the asset. Meaning that the transferor, that is, for example, a person, a man, will be deemed to be the owner. Okay, so for house property it is deemed owner. Write it here. For house property, deemed owner. And for this, right, for others, club. There's a logic, simple logic under income from house property. If a person transfers, if a person has two properties, two self-occupied properties, one is deemed to be let out. So what a person says that, okay, I don't have to hold two properties. I have a spouse, I'll transfer that one property to my spouse. She's also holding one self-occupied property. I'm also holding one self-occupied property. If the clubbing provisions come, then her NAV is zero, her income is zero, that will be clubbed in my hands. My NAV is zero, nothing is taxable. Now the government says, wait, will not club that, will treat you as the owner. So if I have transferred a property to my spouse, that property is also deemed to be mine. So now I have two house properties deemed to, two self-occupied house properties. One will be deemed to be let out. So this is the logic for house property. For 6416, transfer to a daughter-in-law for inadequate consideration. Write it here, for inadequate consideration. Then it has to be clubbed. Here also write for inadequate consideration and not in connection with agreement to live apart. Here write for inadequate consideration and not in connection with agreement to live apart. Here write only for inadequate consideration. This is common for HUF and daughter-in-law. For HUF also, if transferred for inadequate consideration, then only it has to be clubbed. There is no agreement to live apart in case of HUF and daughter-in-law. Okay. For example, now I'm coming to the next concept. For example, I've given some amount to my spouse. Now she is invested into a business. Now investing into a business, she earns some income, profit, and she earns also interest. She earns also salary. Will salary be clubbed? No. Why? Salary is a compensation for effort. It is not a compensation for capital. What is a compensation for capital? Interest and profit. Okay, so that will club, but of course a ratio. If the if the spouse is also investing her own income or his own income, will take a proportion of the income. So opening balances, proportion, please repeat after me. Proportion is to be taken on the basis of opening balance only. Opening balance only. Proportion, so opening balance is of amount received divided by total opening balance into income. We are not including, this is a one mistake box, you write it here, don't include current year contribution. Don't include, write it here, current year contribution. So what you will do is you will take a proportion of opening balances received by me divided by total opening balance, including her contribution, including my contribution. Now we'll multiply it by the income, be it interest, be it profit, and then we'll club in the hands of the transferor. For example, if she had invested in a partnership firm, what would be that? What would be the case? Now, investing in a partnership firm, salary of course will not be taxable in my hands because it is a compensation for effort. Interest will be taxable in the hands of me, and that will be proportionate. What about profit? Share of profit is exempt in her hands as per section 10 subsection 2a. So there is no question of clubbing, because since the income itself is exempt, there is no question of clubbing. Clubbing comes when the income is taxable. Okay. Now let's say we have another situation. Write it here. 64. The section number is 6412. Okay. So a person has a substantial interest in, so suppose I have a substantial interest in HG Private Limited. Substantial interest means I own 20% or more in equity share capital. Okay, so that company is paying to my spouse an amount of salary, and my spouse does not have a what? Professional competence. Does not have a competence. So should it be clubbed? Of course it should be clubbed. Why not? If she had a professional competence and experience, a professional qualification does not mean that it should be degree and only degree. Even experience will count. So if she had experience, it will not be clubbed. But since she is not experienced, it will be clubbed. Okay. The last section is here. Right, 64 1a. 64 1a. 64 1a is income of minor child will be clubbed in my hands if I'm the father or the parent, except three situations. Have a look at these images. These images will help you recall during the exams. So if you say manual work during the exam, you'll remember this hatoda. You'll remember this, and you'll recall, yeah, manual work is not covered under clubbing. What else is not covered? Skill. If the minor child has won out of a singing competition, it is not clubbed. Okay. It If the minor child is earning and the minor child is disabled under section 80U, it will not be clubbed. Okay, three exceptions. Repeat after me. First is manual work. Second is skills, experience, and yeah, technical skills. The third is ATU disability. It will not be clubbed. But any other income, be it any investment income, any income will be clubbed in the hands of the parent. Which parent? The income, the parent who has higher income. Okay. If they are separated, the one who maintains the child. Exemption is 1500 per child. This is over. Clubbing and 56 to 10 are over. Will be coming to carry forward of losses. Okay. If you want to take a break, take half-minute break after pausing this video. Otherwise, you can carry on. Right here for set off and carry forward. Write it here. First, row wise and then column wise. Any loss that you have you see in the exam, in the question paper, first look at the row. Mind it, look at the row. Why? Because this chart says I am loss. What does it say? I am loss. Okay, it says I am loss. I am house property loss. I am allowed intra head set off. I am allowed inter head set off also, but only first year to the extent of 2 lakh. Beyond 2 lakh, carry forward 8 assessment years. I am business loss. Intra head set off is allowed. Inter head set off is not allowed. Yeah, it is allowed only in the first year against every head of income, unlimited amount except salary. A person cannot be doing business and be a salaried person at the same time. Of course, he can be leaving his job after 6 months. What the Income Tax Act says, no set off of business losses against salary income. Okay, it can be carried forward for eight assessment years. Third point is speculation loss. Speculation loss, first of all, only speculation income can against speculation loss, only speculation income can be set off. Okay, be it intra-head or inter-head, only speculation income can be set off against speculation loss. Does that mean any other head losses cannot be set off against speculation income? I'll repeat my question. It says here that speculation loss can be set off against only speculation income. Does that mean any other losses cannot be set off against speculation income? It can be. So just remember it like this. This is a street. On one side there's a speculation loss, on one side there's a business loss. Okay. This is a street. It shows a one-way signboard. It says speculation loss cannot go to other losses. It says like this. But from the other side, it does not show that. Hence, other losses can be set off against speculation income. On this road, it's not like that no one will be walking, no one will be coming on this road. It is a one-way road. You kidding me? Yeah. So speculation loss cannot be set off against other gain, but other loss can be set off against speculation gain. For that, we have to again look at the specific row. So for example, business loss, only if the loss is of first year, then inter-head set off is allowed. And if there's a speculation loss, can it be set off? Yes. Okay. If there's a speculation gain, then it can be set off. Yeah. Capital gains. I'll just explain you in brief. The rates of taxes for heads of income is long-term capital gain. It is maximum rate is 20%. Short-term capital gain may be 20%, 30%, and other is of course 30% considering the assessee is the highest slab rate. So the government does not allow the benefit of claiming the loss of lower tax rate with the higher tax rate. So our memory technique is write it here. Write it here. I am loss, full stop, gravity. Write it. I am loss, gravity. What does it mean? It means that you are a loss. You cannot go up. Gravity means you can come down, but you cannot go up. So if I'm a loss, long-term capital loss, we'll be looking at this. If I'm a long-term capital loss, can I be set off against short-term capital gain or other income? No, this is red. But if I'm other income, other loss or short-term capital loss, can it be set off against long-term capital gain? Yes. Again, this is a one-way traffic. Okay. Activity of owning, maintaining horse races. Only horse races income, so intra-head is also not allowed. Unabsorbed depreciation, it is free. Unabsorbed depreciation and we'll say scientific research capital expense, both. It is allowed against any head of income against any year except salary. Okay. 35 AD income, any yeah, intra head is allowed, inter head is allowed other than salary. Yeah. Section 35 AD. Inter head or intra head both are not allowed. Okay. So, of course, we are not dealing in detail about a setup and carry forward. Most of the points we are discussing. If from the main book, if you want to write some points down in the calendar book, please write it down. Okay. Now, so what did we write here? First, row wise, and then column wise. Now we had gone row wise. Now we'll go column wise to memorize it better. For column wise, is intra-head setup allowed in all the cases? No, it is allowed. It is not allowed in the following cases: speculation, capital gains, capital loss, 35 AD income, and owning and maintaining horses. Is inter-head allowed in all the cases? No, it is allowed. If it is allowed, in case intra-head is not allowed, inter-head will not be allowed. That is for sure. If inter-head is being allowed, it is allowed only for the first year, except in case of unabsorbed depreciation. It is allowed every time, every year. For house property, inter-head setup allowed is allowed to the extent of 2 lakh. For PGVP, there is a restriction on salary. For unabsorbed depreciation, there is a restriction on salary. Years of carry forwards. This column. How many years can it be carried forward? All losses 8 years, except speculation, owning and maintaining horses is 4 years. Indefinite 3. Unabsorbed depreciation, don't you forget scientific research capital expense. It is indefinite, and 35 AD ka loss. The priority of, so it is mandatory to set off losses. If you do not set off your loss, your claim to the set off is lost. You cannot claim it back. Okay. Priority to be decided by the assessee for setting off losses. So priority can be decided by the assessee. For example, if I have a loss and I have two gains: capital gains, long-term capital gains, and speculation income. Now speculation income will be taxable to me at 30%. Long-term capital gain will be taxable maximum at 20%. So what do? I'll set it off against speculation income. Priority can be decided by the assessee, but it is compulsory. However, the priority for PGVP, yes, now focus right here. PGVP priority is specifically first current year depreciation, then brought forward losses. Current year depreciation, why? Because it is a compulsory deduction. Brought forward losses, why? Because it has a limited period. Unabsorbed depreciation, why? Indefinite period. Okay. Now we'll look at section 80. Section 80 says that if you have not filed your return on time, your claim to the loss is lost, except in two cases. Not applicable in case of house property. For business loss, it is applicable, okay? And in case of unabsorbed depreciation and scientific research capital expense, it is allowed even if the return of income is not filed on time. So in a belated return, so you may have heard in your offices that during the audit season you have to file the return of assessee within time if the assessee has a loss. If the assessee does not file the return of income on time, he cannot carry forward losses. But two losses can be carried forward. First, house property loss. Second, unabsorbed depreciation and unabsorbed scientific research capital expense. Okay, that is it for today. We'll be discussing assessment of these entities tomorrow. Thank you.